Welcome to the Zions Bank Economic Update. My name is Joseph Mayans, and joining me is Robert Spendlove to discuss an interesting feature of the post-Great Recession era, specifically weak wage growth. Robert, I think many of us have been surprised coming off such a strong labor market. In July, the U.S. labor market posted 209,000 jobs gained. Unemployment rate hit a 16-year low, and yet something we haven't been seeing improving has been wage growth. Can you kind of speak to that trend and maybe what's kind of going on?
Sure, and just like you said, we would expect that with very strong job growth, with very low unemployment, and we are seeing those shortages as a result of that low unemployment rate. So when there are job shortages, employers should be paying higher wages and we should see bigger wage growth. But when we compare the wage growth that we're seeing, right now our wage growth is right around 2.5%. But pre-recession, wage growth was over 3%. So we're not seeing the kind of wage growth that we saw before the recession, and we're not seeing any kind of escalation in wages even as the unemployment rate drops.
Okay. And so I know, reading through the headlines, every economist has their own opinion on, what they believe is going on with wages, why it's stagnating. Do you have a couple indicators that you look to, that you pick out and that can kind of point to why wages aren't growing?
Yeah, one of the ones that we're looking really closely at is productivity growth. And what is productivity? It's essentially the output per unit of input. Now in this case, when we're talking about wages, we're talking about output per worker. And so as our economy is becoming more efficient, as we're having more technological advancement, as computers are becoming stronger and more powerful, you would expect to see productivity progressively increasing. But what we've seen over the last few years is we're not being able to match the kind of productivity that we saw as recently as the 1990s. In fact, productivity today is about half the rate that we saw in the 1990s. So we've got very low productivity relative to recent history. And then inflation. So the Federal Reserve's goal for inflation is around 2%, which means that prices rise about 2% per year. And for much of late last year and going into this year, we saw that inflation increasing at around that level, rising up to that 2% level that the Fed wanted to see. But just in the last few months, we've started to see that inflation dropping back down. So right now we're right around 1.5% inflation rather than that 2% that the Fed wants to see. And not only is this being seen at the consumer level with consumer prices, but also at the producer level. And so in other words, companies and firms are not able to increase the prices that they charge to compensate for the ability to raise wages and increase employer compensation.
Interesting. So if we kind of zoom out a little bit, look at the broader economy, the broader labor market, are there some underlying trends that are going on there that may be depressing wage growth? Yeah,
so this is where we really start to dig into the fundamentals of why we think that these trends aren't coming in like we expect. So one of them is we're seeing changes in our labor force participation. So we're seeing older workers, those baby boomers, are retiring at an increasing rate. In fact, 10,000 baby boomers are reaching retirement age every single day. So that's having a huge impact. And those older workers tend to be paid a little bit higher than younger workers. As someone's career goes, as they go through their career path, their wages increase. So as older workers are leaving, younger workers coming in, it's having a drag down on that overall wage growth. The second one is who's coming into the labor force in this current cycle. Well, we've seen big increases in lower paid workers coming into the economy. So the lowest 10% of wage earners are seeing big increases, are coming in a lot. We're seeing increases in eating establishments, in minimum wage level jobs, which is good. It's great for those people earning those lower wages, but again, a big growth in the lowest area of the wage spectrum is pulling down that median wage a little bit. And then the last one is kind of the difference between wages and total compensation. And while wages haven't been increasing as much, we are seeing increases in total compensation. So what that means is that employers, rather than putting money towards your bottom line or towards your paycheck, they're putting more money towards things like retirement or time off or health care. And that does help the employee, but it doesn't have that same bottom line effect on wages as we would expect to see.
Okay. So I know the Fed has indicated that the lack of wage growth may just be a transitory phenomenon and that they expect it to pick up in the future. What are maybe some indicators that they're looking at or that you're looking at that may signal an acceleration in wage growth?
Yeah, so this goes back to our basics again. Job growth is strong at over 200,000 in the recent history, and an average of around 200,000 over the last several months. That's good. Unemployment is low, around 3.4%. Again, the lowest in almost 2 decades, so that's looking good too. But we're really looking at that labor force participation rate. We want to be drawing more people into the labor force, getting that workforce stronger and higher, and we're still down significantly from where we were in the early 2000s. And then inflation. Inflation at 1.5% is too low. We want to see the ability of producers to be able to increase those rates that they charge so they can start increasing the wages that they pay out.
Yeah. Well, thank you. I know this is a very relevant topic to many people's lives, and I think a very interesting thing to see how it develops going forward.
Yeah, definitely.
Thank you, Robert. Thank you for joining us for this economic update. For more information and analysis, please visit zionsbank.com/economy.